Hello, everyone, and welcome to the Upside Ticker Talk. This is episode 8. We are January 21st, and we're already more than well through halfway January, and it was a really busy holiday season for everyone. And as usual, markets have not taken a day off, and we've got a bunch of great stuff to share today. Thank you once again for great support in our first year. As I said, this is our 8th episode, and we've got so much different things planned this year that I think are going to be really exciting. I'm not going to divulge all the cool stuff that we're thinking, but we've got a few surprises coming up. But to start the new year, we've actually got our first recurring guest. So Sébastien, thanks for joining us for a second time.
I'm honored.
Yeah, it's the first recurring guest. That's pretty cool. I'm sure we'll have you on a bunch more in the future, but we thought it was appropriate because, the real objective today is to recap 2025. And obviously just with a lot of the meetings that you've been doing with advisors across the country, and just obviously staying on top of everything that's happened over the course of the year, I thought it'd be good to get you on. So thanks for joining us.
Thank you.
Before we get started, just as usual, we recap kind of our last episode, which was really cool episode for those that maybe had a different taste to it than say others, because we had somebody who had a very different background. So we had Bobby Barnes join us, who's our head of quantitative index solutions in the US, and he shared really how he can describe what quantitative investing is, how it's different from fundamental investing, how him and his team have helped develop different ETF strategies over time in the factor world, if you will, also often called smart beta or factor investing, systematic investing. But that was really, I think, a cool episode and really gave you insights into a different lens of investing. I guess, once again, I mentioned for today's episode, recap of 2025. That's not all what we're going to do, Seb. We're also going to answer internet questions, which is also always a fun part of the show. And we got a bunch because the last time we recorded was early December. So we were able to accumulate a bunch of different questions. And I think a lot of them are very topical as well. So that should be fun to go through. And then, I'll ask you some questions on your thoughts for 2026. So where are we going to be heading, and maybe how some of the themes from last year might evolve. And obviously, things have already been kind of thrown into blender, it feels like, in the first month with, different geopolitical situations kind of arising that came not out of the blue, obviously, but maybe developed faster than we expected. So let's get to it. First segment, industry recap. So I'm going to run through headlines. We have the full year numbers now, obviously. We're like I said, close to a month into 2026. So we have everything that happened last year. So it's going to be a bit of a longer industry recap than usual. And then we're going to get Seb's thoughts on some of those main points. So let's get to it. I think we're going to skip December because, to be quite honest, it was much of the continuation of what happened the year. So let's just jump straight into the full year. And I guess the first notable headline is, and we mentioned it all year, so I don't think it's any news to anybody who's listened to our podcast. There's been part of the Canadian ETF industry or follow the Canadian ETF industry for the year, but record year, $125 billion on the year. That's 64% higher than the previous record, which was in 2024. So back-to-back record years. The total assets in the Canadian ETF industry are now $713 billion, which is obviously an astronomical number compared to where we were even 10, 15 years ago. In fact, the growth rate over the last decade is more than 20% a year. So definitely an industry that's still in rapid growth. And it's really, really exciting to be a part of, because there's been also a bunch of new innovation, new types of products, more ETFs that came out. To put into perspective, also relative to mutual funds, because mutual fund is a bigger industry. It has been, ETFs are a much younger type of investment vehicle, but it is the 4th consecutive year that ETFs have brought in more new money than mutual funds. And ETFs now represent 22%. When I started back on our ETF team in 2018, it was about 10%. So that asset share has doubled, from 2018 to 2025, so in 7 years, which is quite impressive. Quick note, maybe from the Fidelity side, we are Fidelity sponsored podcast here. So it was a record year for us as well. We brought in close to a little bit more than 12 billion in assets. That put us 4th out of all providers in Canada. And now we actually sit 6th in terms of total assets under management. So thank you everyone who's supported us. And, obviously a lot of our products, we're very happy with the way that they've, performed since we've launched them. We've had the honor of receiving, different awards for risk-adjusted returns and all that. So really exciting time to be at Fidelity as well. So now let's get into a bit more maybe of the granular stuff. And I'll try to go through this as quick as I can. But definitely from an asset class perspective, equities were leading the way. For pretty much the entirety of the year, it was dominated by international. So anything outside of North America, it represented about, equities in total represent 50% of flows, and about 50% were into international, albeit there was a pickup in US post, I think, April. So understandably so, as those markets recovered from the initial tariff drawdown, if you will. No surprise to anyone, I don't think. Gold ETFs. Gold ETFs brought in more than $1.5 billion in net new assets. So definitely a commodity and a metal that appreciated in value very strongly in 2025 and continued so in 2026, with a lot of the favorable tailwinds seeming to continue to play out, if not even enhance. Actually, I read a note from some of our partners that we work with at TD as well, and they said it was the year of the asset allocation ETF. Really exciting to see, obviously, because that's an area that we play in. Two of our all-in-one ETFs were in the top 10 selling ETFs in Canada, but that category brought in $12 billion. That's double the record of 2024, so really strong acceleration there. And I guess the one really interesting point is it's been extremely consistent. Not a single month of negative flows since the first asset allocation ETF in Canada was launched. So really exciting stuff there. Lots of new launches. I mentioned that. 364 new ETFs in 2025. That's absolutely crazy to me. It took 24 years to reach 300 ETFs, and we launched more than that in a single year last year. So definitely, if you're an investor and you're looking for some type of ETF, like there's more and more probability that you have something that you're looking for. Like I think there was Canadian investors had to go look into the US market to find certain things. It's getting harder and harder to say that now that we have so many different things listed here in Canada. Last point I'll throw it over to you, Seb, in a second. So sorry I took a bit of time to get there, but really interesting trend, and I think we're seeing that in the US as well, is there are more and more active ETFs relative to passive ETFs. And not to say that obviously the passive market is still the larger share. It's more than 50% of the assets, but in terms of total number of ETFs, there's actually more active. And I'll define active as anything that's not market cap weighted index type product. So Seb, I'll pass it over to you. Anything in there that really stuck out to you and that you found, either really interesting or, kind of surprising, or stuff that, has in your mind really a material impact on where the industry is going?
Yeah, there's 4 teams that I saw last year. Number one, you mentioned international. That was pretty obvious and everyone's talking about it. Number 2 being commodities, especially here in Canada with gold and everything happening. And I think the increase in ETF net flows in gold was 75%. So we almost got an 100% increase into commodities. Number 3 was alternatives. We've seen a lot of more alternatives on the market. Obviously, a lot of them are leverage ETFs, but also alternatives like different types of alternatives, such as bonds or solution that also reduces risk, not just solution that increase risk. But number 4, and you mentioned, I think that's the most interesting part of last year, is how the flows diversified, not away, but more and more flows are going towards either active solutions or towards smart beta solutions. So as we all know, is ETF got created initially for passive investing, and almost 100% of the assets initially into ETFs were passive. Today we're about at 70-30, and like 70% passive, 30%. I put active and smart beta within, or quant within the same category here. And then last year, in terms of net flows, that's what's more interesting, is smart beta and quant and active outpaced passive last year in terms of net flows overall. So I think those are the 4. Is it going to repeat itself? I think it's also a situation where the market last year is kind of the perfect storm. Everyone's talking about the over-concentration of the market. More and more solutions here in Canada that are not necessarily passive versus the passive was already available. A mix is also a lot of more and more, not only individual investors, but also brokers and financial advisors are using more and more of those ETFs. So it was just like the perfect storm last year. We'll see if it repeats itself this year, but it started and it seems like to be continuing on the same track.
You mentioned alternatives and like leverage products. Like that's one thing I think we brought it up in one of our episodes. I don't remember exactly which one. It was maybe the one actually I did with Rory when we talked about alternatives. He's our director of alternatives here at Fidelity. It was, in it, especially like when when he started launching liquid alternative mutual funds, it was really kind of more on the risk reduction side,
Yep.
right? So whether it was like hedge fund type strategies, whether it was like a market neutral strategy, a long short strategy where you're using that leverage to reduce risk, that was not really the story last year. And obviously, like markets, performed fairly well in the most part. Like there weren't that many areas that were, but the risk on appetite of investors was evident throughout the year in terms of just like kind of traditional. If you're looking at like equities outsold fixed income, for example, or on even just in the fixed income side, more like a bit more duration than the previous couple years, and a bit more maybe credit risk. So that's like risk on as well. And then you see the like 2 times, 3 times levered type stuff. You also see single stock ETFs coming out. Like those are all things that are kind of evident, I think, to pointing that investors were willing to take on more risk last year. So
we were in a bull market, right? We are in a bull market.
Yeah, we are. Still.
So obviously those types of solutions get a lot of traction, right? They look great on paper. Like,
yeah.
Really good on paper.
Give me 3 times micro strategies.
Exactly.
When it's going up, it sounds good.
That keeps going, because actually I had a note here. Like in the US, they're kind of looking into it a bit more,
cracking down on it a little bit, yeah.
And they've been looking at new launches, especially everything that's over 200%, so 2 times. I mean, if you show a back test, or if you look at some stocks where you would put leverage on it and your solution would be down to 0 today, like I agree, they should look into it.
Yeah, and I think that's the point. I think that'll probably like make its way through Canada in terms of like regulation, and like obviously this is something that came out of the SEC and saying that like maybe small caps, micro caps, and highly illiquid stocks probably should not be in a single stock ETF vehicle and using leverage. So I think that might at least put the brakes on a little bit, but it was definitely a growth area here in Canada. I mean, there's more than a couple $2 billion that went into kind of levered products last year. So definitely something to keep an eye on.
And we talk about alternative like being this asset class, but alternative is so wide, right? Is it even an asset class, right? Because it could be a solution that increases your risk, and it can be a solution that decreases your risk, and it's anything that gives you returns that are basically different than bonds and equities, right? So we've concentrated on these leverage ETF, but there's so many other types of alternatives that we've seen coming up in Canada, either on the real estate side, either on the private credit side. Like those are all technically considered as alternatives. So there's also a growth in other types of alternatives, not just leverage alternatives.
No, for sure. Very good points. All right, well, that was our industry recap. I guess we'll go on to our next portion of the show, which is answering the internet. So Seb, I pulled 5 questions from the internet. Once again, like I think we hit 30 something, which is I think a record for a given month of the numbers we received. So thank you so much for doing that, by the way. We love it. We love answering your questions. We try to interact as much as possible, and it really gives us an idea of also like what are investors and advisors thinking about right now. So let's get to it. So I'll ask you some. You can answer first. I'll take some, and we'll just kind of go back and forth. But I guess the first question I'll ask you is, so the question that was written down was, what questions should investors ask themselves before adding another ETF to their portfolio, even if the current one is performing well?
Good question. So I think I deal a lot with advisors and brokers. It will ultimately depend on what you have currently in your portfolio, and then also looking at what's the objective of your own objective, right? Do you want to increase your risk?
What's your financial goal?
What's your financial goal ultimately? Do you need to buy a house? I'm not a financial advisor, so I can't really answer that. But like, I think ultimately that's the question you need to ask yourself before looking online and say, what's the best ETF? Yes, returns are great. And most of the times we will be attracted to solutions that have the best returns over time. But, a lot of solutions are also cyclical. A lot of if you're going to a leverage ETF, for example, and we do not have a bull market, you will lose money, even though if the stock might be good versus the other. So
I agree with you, and I think that the main question really is like, what's the purpose? Like, what am I trying to achieve with this? So if you're trying to like enhance diversification, well, then the number one question you should be asking yourself is like, what is the am I buying? If you have say an S&P 500 ETF, and then you look at a say actively managed growth manager, like there could be considerable overlap where you think you're adding diversification, maybe not getting it. On the flip side, like if your objective is to say, I really want to enhance X, Y, and Z part, or I want this type of exposure. Well, then, that's where you can go and say, okay, well, maybe I have a broad market index ETF, but I want to get more, juice, or I want to get more growth exposure. Well, maybe you can look at a sector, you can look at a theme, you can look at a factor that has maybe a higher beta or a higher risk profile, if you will, to enhance that. So it's truly kind of what you said is like, what's your goal? What are you trying to achieve? And there's no kind of right or wrong answer with regards to that, I don't think.
But I get it for the investor point. It's getting harder and harder. You mentioned over 300 new launches last year. It's like what's the best solution for my portfolio? I think
that's where you can go see an advisor.
That's yes, that's number one. But number two is also like if you do not know, just make sure you bring something that's diversified, right? So there is solutions that exist that bring a broad diversification of your solutions. So just make sure it respects your risk profile. But for the rest, you'll have the solution out there.
For sure. Okay, second question. If an ETF tracks an index, how often does that index change? And what does that mean for investors who hold it for years? I'll take a crack at it, and feel free to add anything. So first of all, once again, it's like sometimes I feel bad because every time we answer, it's like, it depends. Well, it truly does depend, because every index will have its own rebalancing methodology, will have its own inclusion criteria. So like which companies are eligible to be part of this index, and then what also are the rules for exclusion, right? So like how do they get booted out? So like let's say like the most broadly tracked index in the world, the S&P 500 index, it has inclusion criteria. So you have to have generated a profit over the last 12 months. You have to have generated profit over the last quarter, and obviously there are liquidity and market cap requirements there. But those are also screens, basically, inherent screens. Hence why, I remember back in a couple of years ago during like the pandemic, was like Tesla was not part of the S&P 500, and it wasn't because it wasn't one of the largest stocks in the U.S. It was just simply because it didn't meet some of those criteria. So what that means for the investor. So once again, like how does it change? It really depends on the index. They all have different rules. But what it means for the investor though is that it does change over time. And then obviously performance is probably the number one driver of index allocation. So like your sector allocations drift because of performance. Your individual stock allocation drifts because of performance. Like the size of the tech sector in the US where it is now in say the S&P 500 is significantly higher than where it was 10 years ago because of the underlying performance there. Not so much of because the index manager decided to add more tech companies, right? So what it just means is that it changes over time, and your risk profile changes over time, and so do your correlation maybe with other stuff that you have in your portfolio. I don't know if you have anything to add there.
You've mentioned, I think, even the index that moves the less, so passive indexes, they still move. There is still some changes. So I think it's false to say that you buy an index and it will never change. There's always changes within an index. Obviously, if you go more quant, if you go more active, it will change more. But it will always change, even if you go pure passive.
For sure. And that's actually a good point, right? Because like technically, for a lot of even like here at Fidelity, what our kind of bread and butter on the factor side or smart beta side, it's like, it is an index that we're tracking. That index has rules that are that mean a lot more turnover and are a lot more active, where in any given rebalancing period we have, say, let's take our momentum ETF as an example. We rebalance that quarterly, which means we're rerunning our quantitative model that selects what we feel are the best momentum companies based off of different metrics. Like there could be 10% turnover of the portfolio. There could be 30% turnover of the portfolio, where that could drastically change your investment profile. But that's truly dependent on the independent strategy. So good points. Great. Let's take one more question and we'll get to our interview. I'll ask you some questions.
Okay.
What questions should I ask my advisor when they suggest switching from mutual funds to ETFs?
The answer I always say is everything should be seen as net of fees, right? So performance net of fees. There is some mutual funds that have performed great over the last few years that they should still be in your portfolio. Some did not, and maybe we should look towards more ETFs and try to reduce the fee and try to increase your alpha and your outperformance based on that fee. But not everything is linked to the actual pricing. That would be the first thing. Actually look at the performance of those solutions.
Absolutely.
But be mindful, and be open-minded when you have this conversation with your advisor.
Yeah, no, I think that's a great point, right? Like net returns is this manager giving me excess returns over time? Exactly. The last point I'll make though is that, like, obviously certain managers have certain styles, and similar to, investment factors, sectors, themes, like they have their time in the sun where, sometimes you might be, willing to move away from, say, an actively managed mutual fund to something more passive, or it could be an active ETF also. But, maybe there's a reason that manager is in the portfolio. Maybe it's because they have a great downside capture ratio. Maybe they've, right. So there's also that rationale of like style. So I take that in consideration, but definitely I think at the end of the day is like, is it worth, the money to pay for? And obviously, like we see it here, we're extremely biased, but we have some of the best managers in the world here at Fidelity. So we can see the value out of a lot of these actively managed mutual funds. So I think it's truly about understanding what you want out of it and is it delivering? All right, let's take one last one. Let's do one last one. What are common misconceptions people have about ETFs that only become obvious after they've been investing for a few years? So what are common misconceptions? Yeah, people have. Yeah, okay.
Well, I'll bring one. There's many points that you can bring, right? There's many different answers, but I'll just continue on what you mentioned. There's some mutual funds that have done great over the last few years in terms of returns, and those mutual funds now more and more are also available as an ETF, right? So just be open-minded. Like sometimes some ETFs are also active. They do have a higher fee, but net of fees, they've done quite well. So I think that's the first thing where like, okay, well, there's different types of ETF out there. They're not just all necessarily the cheapest version of the solution. That would be one of them.
Yeah, no, that's definitely a common misconception in terms of like what becomes obvious over time. Like that's kind of hard to say because I think it's maybe some people realize certain things after. I think it's one that I've heard before anyways is, a lot of investors, advisors who buy ETFs, the way that it trades is very similar to a stock. And you're saying, okay, well, I'm selling X stock to buy X or Y ETF, and it's a package of multiple stocks. So inherently it means it's less volatile. Depending on what you buy as an ETF, that's not necessarily true, right? So it's just because there's multiple underlying securities. Yeah, I mean, portfolio theory would say, yes, of course, if you have more securities, you have a lower standard deviation because they kind of offset each other in certain periods. But if you have something that's very specific, let's take, a cannabis ETF back in, I'm buying, a pool of all these companies. So if one doesn't do well, the other one's going to offset it. Yeah, you were taking on very serious subsector risk of basically to one industry. And, you saw some of those ETFs go down 50, 60, 70% as that kind of rolled over post-COVID when, maybe we realized, well, that market's maybe not, $1 trillion. It might be X. So I think that's one thing that maybe is a misconception that you can find out on the later end. So maybe that's something to keep in mind. All right, so that was answering the internet. Let's get to our last segment. Seb, we've talked about a lot about last year. We've answered some questions, but let's try to, take a lens. Maybe let's start to look a little forward and just thinking, what are some things that we're going to keep in mind for this year? So I guess my first question to you is, what are some of the trends that we talked about earlier that you think could continue this year? And maybe, one that, or two, or how many you want, that you think might reverse?
Well, I mentioned 4, and I'll go back on the 4. And then,
okay, so, perfect. Yeah,
the first one I mentioned is international. We've seen international reducing a little over the last few months.
Yep.
The international trade was really strong at the beginning of last year. We don't have yet fully the January number, but when those geopolitical tension happens, maybe we'll reverse back to, again, international. I strongly believe that over the long term, the U.S. dominance will come back in terms of ETF and exposure. Most of the stocks are based in the U.S. And in terms, if you look at earning revision, if you look at financial statement and companies' profitability, in general, on average, the U.S. have a bit more to offer than international. So
as an aggregate, right? Because we're talking the whole market here. Yeah,
exactly. But it could continue in the short term for sure. I think international is in general cheaper if you look at forward PE, and a lot of our manager talk about this. So in terms of opportunity, it is quite maybe in the momentum or the trend we can see in the short term. So that would be for international, but I don't see it keep going over the medium long term. I would say.
I'll throw you a curveball there, during that one, because I think obviously flows tend to track performance, right? And obviously we had a really 100%. Strong year in international markets last year. A lot of things that hadn't worked for a while, like European banks had a phenomenal year. Do you think that a lot of the flows that we saw last year are due to that performance and then kind of accelerating as we saw internationals continue? Or is there also and not to get in like political or anything like that, but like a sentiment from Canadian investors to say, maybe I don't want to own as much US given, everything that's going on in the world, maybe a more domestic stocks and or more, stocks in Europe, Asia, like in conversations that you've had, is that like a real thing, like divesting away from US companies?
It's both. Technically, it's the perfect storm. It's both. But I'll ask you a counter question, and it's pretty much going to answer it. If international market did zero, did zero last year, would we have the flows in international markets?
No, it's
right. So return does have a large part of the answer, but yes, it is the perfect storm between the two.
Okay. No, once again, it's maybe an unfair question, obviously, because we don't know, but
returns always matter.
But returns definitely do matter, because as I said, actually, also, right, like you saw it kind of reaccelerate, post April in the US, so definitely has something to do with that. But
So I said
cut you off.
So
sorry, go ahead.
International was number one. So international, I'd say maybe probably short term. It is, the momentum is still there for sure. But long term, medium term, US is still the dominance. Commodity would be the second part I mentioned. Commodity is really historically, as we all know, really cyclical. Are we in a different type of market? Maybe. I'm not gonna get into this, but commodities, we've seen central banks buying more and more gold.
Yeah.
The fact that gold and a lot of commodities are also offered as, you can buy gold now as an ETF. It's less of like, I got to go to Costco and buy.
Yeah,
the
bars.
Little
bars of silver and gold.
There's other ways now to buy gold. Actually, 74% of the flows of a net gold purchase last year was done with ETFs.
Really? I didn't know that. In the US.
74% historically.
So only 26% like physical gold, like people.
Jewelry, physical gold.
Yeah, okay.
Stuff like this. Historically, it's been, over the last 10 years, it was at 24%. So there's a huge increase by having an ETF or solutions that are more flexible to investors and advisors, which makes a difference.
But inherently what you're saying also, though, is that like investors drove gold prices. To a certain extent. I mean, if it's representing the largest demand side part in the U.S., notably, maybe not so much. I mean, it's definitely not the case elsewhere, because the U.S. ETF market's so big relative to others. But that's still a crazy stat. I had never heard that stat. Yeah. So thanks for bringing that up. Learn something new every day.
But commodities, so it is a cyclical solution. So I wouldn't be surprised either if it goes down, right? But I'm not.
Yeah, I mean, that's definitely going to be a price action follow type thing, right?
100%.
Like, I think
there's not much to predict on this. The other two part, alternatives, I think is keeps going. I think the only thing that can get into the way of alternatives is those solutions that have a lot of leverage with everything regarding to regulations and a market that goes down, right? That will impact definitely alternatives, but it's going to help the other side of alternatives, right? The solutions that are not correlated, or
covered call strategies,
exactly, right? So
put writing strategies, things like that
on both sides. And then the last fourth point I brought is active or quant solution versus passive. That's definitely a trend that I see keeping going, especially this year, just because the concentration of the market, of the ETF market in Canada, is mainly passive. So just in terms of expansion over the next few years.
Yeah, and I think it's been fairly challenging environment, I'd say, for like, and once again, this like broad stroke, like active managers, systematic, like quant strategies. Like, it's not easy when only 30% of stocks in the US are outperforming. So it's hard to like consistently pick those 30%. And it's not been the same 30, let's call it, I don't know, 150 stocks out of 500 or something like that in the S&P 500. Like, if you have a broadening market, if you have opportunities arising in other geographies, like a global manager might be advantaged if things are working in Canada while they work in international markets, while they work in EM, maybe, and obviously some US stuff works. I think it's an environment that could bode well for maybe something that's like, certain indices have been really hard to beat. Like, Canada's the best example last year, I think, with like the S&P TSX was up, what is it, close to
31 point something percent.
Okay, that's very precise. Yeah. Much better than I would have given out. I said about 30%. But so, right, it's up about 30%, a bit more than 30%. But if you didn't own precious metals, you were missing a third of the return.
Materials were 36% of the return, and then gold is like 31%.
See, I throw out large numbers. You're much more precise. I say a third, you say 36, and that's
I
perfect. That's it. But it's crazy, right? So like if you're an active manager and you weren't overweight gold, or you weren't neutral, it was very hard to beat that index. And it's like you have these concentration in stocks, in sectors where, if you have more kind of like a broad and maybe a market that's a bit more flattish, it could be a really good environment. So I think that trend can continue not only by innovation and more options, but also just a market that's more prone to active management and active share. So, okay, awesome. So we have a number of different factor ETFs here at Fidelity. We just mentioned a few there. So like our US value, we talked about momentum earlier. Is there one style or factor that you think has some tailwinds right now?
Two factors. One, just also in terms of performance, the momentum factor has been quite popular. I also believe, considering we do have a lot of shifts in the market over the last few years, considering it's a factor that moves a lot, it could be interesting. And in terms of comparison to what traditional portfolio will hold, so like banks in Canada or telecom in Canada, for example, your momentum will sometimes catch something you do not hold. And a great example here is Canada. Is last year, Canada, we mentioned before, 30% or 35% was due to materials. But a lot of portfolios do not hold materials, right? So, and mutual funds and regular active ETFs also do not necessarily hold materials. So suddenly last year, you underperformed the market because you didn't hold that asset class. And having a momentum would have made sure to pick that in a period where, and you don't necessarily want to pick individual stocks on the material side, for example. And
remove some idiosyncratic risk, buy the basket.
Exactly. So momentum is one team that comes up a lot, either international momentum, US momentum, Canadian momentum, regardless of geography. The other team that comes up a lot, or factor or smart beta that comes out a lot, is value. Our value
factor is kind of counterintuitive, right? Because usually value and momentum kind of rarely work in tandem, but it seemed like they did last year.
And it's actually interesting. So if you look at the cycle, technically, early cycle would be value, and then more we go
small caps, value, that stuff, and
then mid cycle, late cycle, then we go more into momentum or quality, and then in recession, usually value does not.
No,
right? Technically, it does not. So a lot of the question I get asked is like, okay, well, value's been doing good, momentum's been doing good. Are we going into a recession, and should I sell my value? Should I sell my momentum and go low vol? And so we've looked into backtests and looked into when does value perform at the same time as momentum, as we've been seeing over the last few months. And the last time that happened was during the tech bubble. So between 2000 and 2003. It's actually one of the only time where we were in a recession, I'm quoting here, recession between a dot-com bubble, and where our value factor did quite well. Because most of the times in recession, like I mentioned, the value factor did not. So, and there is some comparison to be made with today's environment, where maybe the reset or that recession is just going to be because of the concentration of the market we've been seeing right now, and the fact that the top 10, top 7, which can be compared to the main dot-com bubble stocks that we've seen in 2000, were highly concentrated in the US market. So maybe value could maybe skip a cycle and be quite interesting in this, if ever we get a reset or a recession. So momentum will be your fully bull market. And so usually would go low vol when we go into recession as a counterbalance. But what if that counterbalance is value? Why can't we use value if there's a lot of comparison in the current market with what we've seen in 2000 and 2003? And
higher a lot valuations, concentration.
Exactly. So that would be the two teams that I'm bringing a lot with our meetings day to day recently.
No, that's awesome. Thank you so much, Seb. And look, I mean, we've already been recording for more than what we had planned. So I'm going to leave it at that, and we'll leave some other questions for the next time you come on, which, like I said, Seb's been our first recurring guest, and I'm sure he'll be back on. So I guess I'll just wrap up the show and say thank you to everyone. Thanks for listening. Keep submitting your questions. You can always catch our previous episodes on YouTube, your favorite podcast app. We'll see you next time. Thank you.